Hi, this is Prashil, and you're listening to the Equity Master Stock Market Wrap Up. In this week's edition, I'll be taking you through what moved the markets over the week. So let's jump right in. India's economy is slowing down. The US Fed holds its rates. Is India's auto sector in a slump? We'll take a look at these and more in today's edition. Now, a quick look at the broader markets. Global markets fell following cues from Wall Street despite better than expected macro data from the US economy. Data showed that the US economy grew by 3.2% in the first quarter. A robust performance indeed. Back home, Indian indices ended the short but very volatile week in red. With the markets out of the way, let's look at the key stories in focus today. The Finance Ministry, in its monthly economic report for March, said that the Indian economy slowed down slightly in FY19, although it still maintains the tag of the fastest growing major economy. The factors responsible for this slowdown include declining growth of private consumption, a tepid increase in fixed investment, and muted exports. It further said that there is a slowdown of growth in agriculture and sustained growth in industry as well as some other challenges. The ministry also pointed out that the consumer and wholesale price indices have declined in FY19, though inflation has firmed up slightly in the recent months. The current account deficit as a percentage of the GDP improved in Q3 FY19 and is set to further improve in Q4 as the dip in imports has improved the merchandise trade deficit. In line with the declining real GDP growth, private consumption in Q4 of FY19 has also declined, as reflected in the drop of growth of two-wheeler sales towards the end of the year. On the external front, the report said that the current account deficit as to the ratio of GDP is set to fall going further, which will limit the leakage of growth impulse from the economy. The report also indicated that monetary policy has attempted to provide a fillip to the growth impulse through cuts in repo rate and easing of bank liquidity. The room for this monetary easing has been created by low inflation in FY19, although, as I mentioned earlier, it has also started to inch up in the last few months. So it's prudent to be careful on this front. Now, one way of gauging the government's financial health is by looking at the fiscal deficit as a percentage of GDP. So far, it has been in line with the government's stated aim of bringing the fiscal deficit down. Now, how this plan pans out going forward remains to be seen. Moving on, the domestic automobile sector seems to be in a bit of a slump. Tata Motors and Mahindra reported decline in sales for April, hit by a subdued demand in the market. Similarly, Toyota Kirloskar Motor also reported a decline of 22% in its domestic sales last month. On Wednesday, the country's two top car makers, Maruti Suzuki India and Hyundai Motors India, also reported a decline in domestic sales for April. While Maruti reported an 18.7% fall, Hyundai posted a decline of 10% in domestic sales for the first month of FY20. Tata Motors said its passenger vehicle sales in domestic market declined by a whopping 26%. Meanwhile, M&M saw its passenger vehicle sales drop 9% in April. Reportedly, the industry has recorded a degrowth for the 10th consecutive month. Weak consumer sentiments are reflected in this demand degrowth. Note that the automobile sector is a bellwether for the economy as a whole. Declining auto sales numbers should sound a warning for a slowing economy. In news from the global markets, the US Federal Reserve announced that it is holding the benchmark interest rate steady at a target range of 2.25% to 2.5%. In doing so, the US Central Bank also noted that inflation is running below its stated target of 2%. In a technical change, the Fed also reduced the interest it pays on excess reserve parked at the central bank as part of an effort to stop effective interest rates from breaking outside of its current target range. The Fed's decision to not change the rates affirmed the March meeting's economic projections, signaling no rate changes for the rest of 2019. In that meeting, the Fed said low measures of inflation, concern over global growth, and tightening financial conditions warranted pausing on interest rate hikes while policymakers reassessed the data. The decision also comes as President Donald Trump called for the US Fed to cut rates by as much as 100 basis points. The central bank statement walked back its March view that the economy had slowed down from the end of last 2018, noting that recent developments show that the economic activity rose at a very solid rate. Impressive GDP data released last week showed the US economy expanding by 3.2% in the first quarter of this year. The Fed, however, said that household spending and business fixed investment slowed in the first quarter. On employment, the committee repeated its March language, describing the labor market as strong with job gains remaining solid. Well, that's all from us today. Before signing off, we would like to know if you like our podcast. Is there anything specific you would like us to cover? We would love your feedback. Just visit equitymaster.com and drop us a line. We look forward to hearing from you. Thank you and happy investing.